Right friends, welcome back to Banking Awareness. This is the 15th lecture and we are going to discuss important terminology in banking, and this module and the next module, 16th module also, we are going to discuss important terminology. And this module, the first one is the difference between dear money and barren money. What is dear money? Dear money is the money available when the interest rate structure is very high. The money which is borrowed at high interest rate is called dear money, because when the interest rates are high, the availability of money supply is very less. Normally, interest rates will be on the higher side when the circulation of money is less. Under those circumstances, people will borrow at high interest rates, and that is not normally conducive for the economic growth of the country, and that is called dear money. Please don't forget, when someone borrows money at high interest rates, that is dear money. Look at the other word, barren money. What is barren money? Barren money is the money which is idle is barren money. Normally, if you have money, you will invest in some financial instruments, you will invest in some physical assets, and you will use it for purchasing something. But when you keep that money in safe deposit lockers, if you keep that money in your almirah, you are the loser because of inflation. Barren money is the money which is kept idle without any investment, either in financial assets or in physical assets or purchasing something. If you are not doing anything, if you are keeping money within almirah, or if you are keeping money in safe deposit locker, if you are keeping money below the mattress, then what it indicates? It indicates that the money is unproductive and it loses its value because of inflation. If the cost of this is 1000 rupees, because of 10% inflation, this will cost 1100 after 1 year. If the inflation is 10%, this will cost 1100 after 1 year, and if I have 1000 rupees, I can purchase this item today, and if I keep 1000 rupees in almirah, if I want to purchase after 1 year, I cannot purchase because of the reason inflation. So, because of inflation, barren money lose its value. Look into the next one, narrow banking. What is meant by narrow banking? Narrow banking is the obsession of the banks to invest more in government securities. All of you are well aware, for a statutory liquidity ratio, as part of monetary policy, Reserve Bank of India stipulates SLR, that is mandatory. At present it is 21.5%. That means banks are required to invest either in cash form or in gold form or in government securities. But banks have got obsession to invest more in government bonds, in government securities. Banks have got obsession to invest more. Why banks invest more in government securities? Because it is the safest investment, risk-free investment. That's why banks, instead of giving lending to outsiders, they will invest more in government bonds, and that type of banking is known as narrow banking. And shadow banking. Shadow banking is, if you want vehicle loan, you can go to State Bank of India or some Bajaj Finance or some other finance company. If you want gold loan, you can go to bank, or you can go to Manappuram Finance or Muthoot Finance or some other gold finance company. If you want consumer durables loan, you can go to bank, or you can go to some non-financial banking company. So, the activities which are being undertaken by banks are also being done by other non-banking financial companies. Whatever the banks are doing, except some operations like demand deposits, this non-banking financial companies are also doing. So that is why the operations undertaken by non-banking financial companies are known as shadow banking. When the same operations are done by banks, when the operations are done by non-banking financial companies, there is a difference. Banks are well regulated in the country. Banks are not expected to fail, and your money is assured in the banking system because of the stringent regulation by Reserve Bank of India. But several non-banking financial companies are poorly regulated and the propensity for failure is more. That's why shadow banking is least regulated, and sometimes consumers will be at risk because of this shadow banking, right? So shadow banking are the operations undertaken by various non-banking financial companies similar to the operations undertaken by banks, but the basic difference is banks are well regulated and this non-banking financial companies are poorly regulated. That's why the customers are at risk when they are undertaking financial activities with the non-banking financial companies. As far as possible, please use the services of banks instead of NBFCs. Universal banks and differentiated banks. The banks which you are dealing with nowadays, like ICICI Bank, Axis Bank, Bank of Baroda, Punjab National Bank, these are all coming under universal banks. The recent licenses given for Bandhan as well as IDFC are also universal banks. What is meant by universal bank? Universal bank can undertake any activity, any financial activity, like giving long-term finance to corporates, like giving project finance for multi-billion dollar deals in this country. If someone wants to construct 5,000 crores of rupees of project, banks can undertake finance, that is project finance. They can give thousands of crores to corporates. They can be into insurance business. They can be into mutual funds. They can issue credit cards. They can grant loans to consumers. They can be into retail credit. They can be into investment banking. What not? So nowadays banks are doing everything that is universal banks. Nowadays the banks are universal. They can undertake any type of operation. But recently Reserve Bank of India gave in principle approval for payment banks and small finance banks. They are differentiated banks. These payment banks and small finance banks are differentiated banks because they can undertake only narrow range of operations. If you look at payment banks, they can make payments and remittances. They cannot give loans. They cannot undertake any other operations like project finance, or they cannot undertake investment banking or mutual funds or insurance. They will be specialized only for payments and remittances. Similarly, small finance banks, their main core area will be lending to small artisans, lending to small firms with value of loan not exceeding certain limit. These are called differentiated banks because they can operate in only narrow sphere of operations. They will be specialized in their narrow sphere of operation. They cannot undertake all types of banking operations. Reserve Bank for the first time gave licenses for two types of differentiated banks recently. Right? Are you clear about universal bank and differentiated bank? Let us look at dovish monetary policy and hawkish monetary policy. What is dovish monetary policy? Dovish monetary policy is, you know about doves. Please look into this picture. When more money is in circulation, when CRR is reduced, when SLR is reduced, when repo rate is reduced, this is a dovish monetary policy. It puts more money in circulation. It leads to credit offtake, more credit offtake from the banking system. The opposite is hawkish monetary policy. Hawkish monetary policy is when CRR is increased, when SLR is increased, when interest rates are increased, the meaning is less money in circulation. That's why the interest rate structure will be high. That is hawkish monetary policy. Look into the next one, hot money. What is the difference between hot money and hot currency? Hot money is basically the money which moves from one country to another country so as to take advantage of short-term gains. If a stock market in India is rising, American foreign portfolio investors will invest in Indian stock market. If the stock market is crashing, they will move to another country like Brazil, or maybe South Africa, or maybe Mexico. They will move from one country to another country. That is a hot money. They look for short-term gains. So the hot money is the money which moves from one country to another, and it is dangerous from the perspective of emerging economies. When suddenly money flows into the country, then that currency will artificially gain, or stock markets will gain. That is, asset bubble will take place. When the money goes away from the country, sudden crash will take place. So emerging markets may be affected because of hot money. Next one is hard currency. Hard currency is the currency which is normally expected to be relatively stable. That is one point. That should be relatively stable. Second point is widely accepted for various payments across the world, and highly liquid in the foreign exchange market, and they are normally belonging to politically, economically stable economies. They belong to politically, economically stable economies, widely accepted in foreign exchange market. For international payments, that currency is widely accepted and it is to be relatively stable, and at present United States dollar, euro, yen, these are the currencies which are considered to be hard currencies, and more than 60% of the world's transactions takes place in United States dollar. Right? So if you want the best example of hard currency, that is United States dollar. The difference between term loans and revolving credit. What is term loan? Term loan is the loan. Banks will give you loan. You are required to pay back at regular intervals. Except agriculture loan, remaining loans are normally required to be serviced every month. Whether it is house loan, whether it is vehicle loan, whether it is personal loan or corporate loan, once the loan is given, you are required to pay back at regular intervals, which is known as servicing of loan, and the loan is given to you at once. That is term loan. Revolving credit is different. Revolving credit is the limit is given, and depending on your requirement, you will take from bank and pay back, take and pay back, take and pay back, subject to the limit. So the example of revolving credit is overdraft account, cash credit account, credit cards, then Kisan credit cards. These are all examples of revolving credit. Please don't forget. The limit is given. You can borrow up to the limit, right? Look into the last one, difference between greenfield project and brownfield project. What is the difference between greenfield project and brownfield project? When a project is started from scratch at a new location. One example is Shamshabad Airport in Hyderabad. Previously, the airport was in Begumpet. Government has got two options, whether to upgrade the infrastructure at Begumpet Airport or constructing new airport altogether at a new place, and constructing the new one or constructing any new project at a new place is known as greenfield project, and brownfield project is developing the existing infrastructure. If the Chennai airport is developed there itself, that will be brownfield project. If Kolkata airport is developed there itself, that will be brownfield project. Delhi airport was expanded at the same location, and that is brownfield project. So, the brownfield project is if the infrastructure is upgraded at the same location, that is brownfield, and infrastructure is developed all together at a new location, a new project is constructed, that is greenfield, right. So, the difference between greenfield and brownfield is now clear to you. With this, let us conclude this 15th lecture. Please do join for 16th one. We are going to discuss some more terms in 16th lecture. Friends, have a nice day. Thank you.